because you said the market goes up and down, and we're all very aware of that, and clients go through that for 20, 30, 40 years while they're saving for retirement. But they don't know any better because they have a financial advisor, they have an investment advisor, they have a stockbroker, and that broker is compensated as well as their knowledge base is based on accumulating those assets for a client. Why is that not correct when you enter retirement? Why do I need to change that phase from being in the stock market to now being concerned about being in the stock market?
Well, I think there's many reasons, Jim, but let's pick a couple of the main points. The first is if you look at what happened in the stock market, let's use the S&P 500 index, which is recognized as probably the mainstream view of how the stock market, equity markets are working, especially in the United States. If you look at that from 1999 through 2013, there was tremendous volatility. If you look at what happened in 2000, 2001, 2002, the stock market went down by almost 50%. That means if you had $1 million in your portfolio and you were invested in the stock market, there was a good chance you lost $500,000 of value in those 3 short years. If you're retired, how can you recover from a $500,000 loss? Very tough. Now, think about if you lost $500,000 and you also took out 5% of your portfolio during that time period. That means not only did you lose 50%, but you also took out 15%, so you actually would have been down 65% of your $1 million. You'd have been down $650,000 just to be able to take 5% out on an annual basis. So that's very tough. Then you look at what happened in 2008. The stock market went down almost 40%. So now not only did we maybe come close to recovering, but now the market took another big hit. How can you suffer almost a 50% loss and then a few years later suffer a 40% loss and expect to get income that would be guaranteed for as long as you live? It just doesn't work.
Well, Dan, if the stock market isn't right for retirees, what about going to certificates of deposit, CDs?
Well, CDs can be a safe place to put your monies, and we look at that as a great alternative for liquid money. What I'd like to look at is, I'll finish on the stock market and go into CDs if that's okay with you, Jim. The stock market from 1999 through 2013, it did go up. And when you look at the graph of the stock market, it looks like it went up substantially, but it really didn't. So over the long haul, 15 years, the market went up. But if you can imagine with how much volatility, almost a 50% loss, almost a 40% loss of the stock market, that during that entire 15-year time period, if you went through that volatility, you would have only gained a 2.75% gross annual rate of return from the S&P 500 index. 2.75% without fees. If you paid a 2% fee to your advisor for your advisor's fee plus money management, it means you would have averaged a 0.75% average annual rate of return during that time period. In addition, during that time period, there's 5,478 days, Jim, between 1999 and 2013, 5,478. There was a time period that we talk about in the book called the 4,913 days of nothing. The 4,913 days of nothing means there was a 4,913 consecutive day time period where the S&P, the stock market, earned 0% for 13 and a half years. How can a retiree expect to be successful when you earn 0% for a 13 and a half year time period? Very difficult. You ask about CDs because people that didn't like the stock market, where did they head to? They headed to CDs. CDs are safe. They used to be a retiree's best friend, but no longer, because CDs in that same time period between 1999 and 2013 lost 96.2% of their interest earning. Think about it, losing 96.2% of their interest earning. So the CDs actually did worse in a roundabout way than the stocks did. So if you had a $450,000 CD in 1999, you would have earned over $24,000 of income. That would have been acceptable for a lot of retirees, $2,000 a month. That same $450,000 CD in 2013 would have earned you $900 of interest for the entire year. Not per month, but for the entire year. A retiree cannot use CDs to provide a substantial amount of ongoing guaranteed income.